Welcome to Navigating Now, real talk for rocky times. A Pete the Planner CalmCast.
Happy Tuesday, May 13th? Question mark. It's May 13th. It's Tuesday. It's 2 p.m. Eastern, which means this is what we're doing for the next 10 minutes. Me, we're talking about what has happened in the market and the economy since the last time we got together, which, by the way, was last Thursday. A lot has happened. We're also going to hit three concepts today. We're going to talk price earnings ratio. Your nerd factor is going to go through the roof by the time this series is over. And today's a big part of that. Price earnings ratio. We're going to talk producer price index, the old PPI. I'm not sure anyone calls it the PPI, but we're going to learn what it is and why you should care. Then we're going to talk about car affordability because it's related. No, really, it's related. Since the last time we gathered here together, boy, have there been some developments. This past Sunday, Mother's Day, the Trump administration announced a pause of the Chinese United States trade war. We paused a ceasefire for 90 days, which also means they dropped the reciprocal tariffs, or what you could also call the punitive tariffs, down to 30%. That is to say, anything that China exports to the United States, they're going to have to pay a 30% tariff. And of course, that tariff is likely to be passed on to you. So consumer prices are still going to rise for goods purchased, which originated in China, by 30%. Is this good news? Is this bad news? Well, it's not bad news, right? It's not bad news in the sense that at least they're not going to cost 143% more. It's going to cost 30% more. And this is definitely a de-escalation. So ultimately, it could be a good thing. Still uncertainty, because by punting for 90 days, we still have to figure that out. And also, there are still well over 100 some trade deals the United States has to do now in about the next 45 days, unless they're going to punt again. This matters to you. The market recovered yesterday, the 12th, in a very spectacular way. The Dow Jones was up about 1,000 points. And now, as of today, the 13th, we're back in. 2 minutes and 30 seconds in, we're already back to today. The S&P 500 is flat now for the year. Flat. What does that mean? It means it was down a ton. We were down 13, 14% loss in the year. So that meant about a month ago, if you had $100 at the beginning of the year, it meant that you had about $86, $87 about a month ago. Today, it means you got $100. You started at $100 on January 1st, and you got about $100 now. So it is flat. Flat is good because it's on the way up to up, which is what we want. Okay, enough about that. Let's learn some stuff. Price earnings ratio, PE ratio, as you often might hear people call it, is the price of a stock divided by, so what you got to pay for the stock, divided by the earnings per share. Okay, so there are earnings, there's profit, and to get earnings per share, you take all of the profit and then you divide by the number of shares of stock that are out there. Let's say you have $100 in profit, and there are 10 shares of stock. 100 divided by 10 is 10. Therefore, your earnings per share would be 10. But to get a PE ratio, you go the price of that share divided by that 10, and that's how you get it. And this should tell you something about whether a stock is a growth stock, meaning it's got a ton of upside. Like if things go right, it could really be worth a lot someday, and those earnings could really be delivered. Or it could tell you that with a low PE ratio, that, you know what, this stock is very stable. It is what's called a value play, meaning you didn't have to pay a lot for it to get a solid company, right? So sometimes you got to pay a lot to take a risk for a big outcome, or you can pay a little to not take much risk and to have a smaller outcome. Let's talk a real world example. Let's stick in the car industry because we're kind of talking cars today for some reason. General Motors, GM, as you might call it, share price is about $50 per share. It's more, it's 50.48, but do you care? It's 50, okay? That's the price. The PE ratio is 7.28. Okay, so that's just a base level. That says GM's PE ratio is 7.28, which I have to tell you, pretty low. That means it's a value stock. It is tried and true. It's not going to do crazy things. In relation to the other example I'm going to give you today, which is Tesla, which is $333 and change per share. And its PE ratio is 183.48. It just went up in real time as I looked at that. 183.48. What does that mean? It means that the potential for Tesla to provide massive earnings is more substantial than GM's prospects in that regard. So that is to say, theoretically, over time, people believe Tesla could have a bigger return, but they're willing to take a lot of risk and to pay a lot for that chance. And GM is the opposite. People don't think there will be a massive return, but they think there will be a reasonable, safe return. That's a PE ratio. It's a way that people evaluate whether something has potential or whether it does not. Let's move on to producer price index. This is sort of the precursor to inflation. You know, there's a lot of talk, especially if you listen to this show, this here
CalmCast,
about steel and aluminum tariffs and how those tariffs and the tariffs on parts for the cars we're manufacturing here are going to make the cost of assembling these cars more expensive. Well, that increase would be seen in the producer price index. How expensive is it to make the items to put together to then sell the end product? So inflation is what is the cost to a consumer to purchase a product. The producer price index, again, precursor to inflation, is what does it cost the manufacturer to put this thing together before they even sell it to you. If the producer price index is increasing, it means inflation is going to increase soon. That being said, inflation report came out today and it was under control. We've got the lowest level of inflation since 2021. That is a good thing. Finally, since we're talking cars, for some particular reason, I don't know. I'm programming it. It's not like I'm blaming somebody else. Cars are expensive. Breaking news.
CalmCast.
Cars are, the average car payment in America is north of 700 American dollars right now. That's a lot. That's a lot, especially when you look at real wage growth, which we've talked about on this show before. This is to say that one of the segments in our economy that you've been hearing a lot about that are going to be really impacted by this round of tariffs from the Trump administration are car prices. You're going to see, because of the producer price index increasing, you're going to see car prices increase as well. There's going to be an inflation rate attributed to cars. And with interest rates still higher than they were a couple of years ago, I'm not going to call them high, they're relatively high, then you're going to see it's still pretty expensive to borrow to pay for a car. That's to say, it's not a great time to buy a car. It's just not. Until those tariffs come down, or until cars start being manufactured here, which means we got to build the plants and transfer the production here, it's just not an ideal time to spend $700 a month for the average car payment in the United States, which is to say, create a new plan. Like, don't get in that game. Drive your car a little bit longer. Repair that thing. If you're going to buy a car, buy a used car until these things work themselves out. Again, I don't make a ton of predictions. You know what? You know who says that? People who make predictions. I guess I do. I'll just say this. Watch the producer price index, the PPI, over the next few months, and that will tell you. If it's going up, it means car prices are about to go up. PPI is down in the last 30 days, but it is up in the last year, just so you know. That's it this week's show. Thursday of this week, we are talking 52-week low and high, what you can learn from that. We're talking retail sales numbers, and finally, a subscription audit. Oh boy, you can subscribe for free to the Pete the Planner podcast, please do so you can always listen to Tuesdays and Thursdays.
CalmCast.
That's it for now. I'm Peter Dunn. Thanks for being here, and I'll see you on Thursday.